So one of the things I cover in my weekly workshops is the concept of depreciation and using depreciation to tax deduct and to save potentially thousands of dollars every single year on your tax. Now, I'm not going to go into how that all works because it's already explained in the workshop. And if you want to watch one of the workshops, you can sign up for the next event, which is somewhere probably below this video, right? What I want to talk about today is around new versus old property and what's the difference between the two when it comes to tax deductions. There's a couple of pretty significant differences when it comes to depreciation and tax deductions overall, okay? There's a very big difference between a new property and an old property, right? The first thing is this. The first thing is that when you buy a new property and you tax deduct that new property, you can get the full benefit because it's brand new. Typically what happens is that every single property will go through depreciation over time, okay? Typically the depreciation will last for around 40 years. Now, if you buy a new property, you get the benefit of that depreciation from day one of buying the property, okay? Now, put this into perspective. If you're buying a second-hand property, and let's say the property is 5 years old, then you've lost the first 5 years of depreciation, okay? Because you've bought into it 5 years down the track, 5 years after it was built. That's pretty significant because the vast majority of the depreciation comes in the first couple of years. It comes in the first decade typically because it's a diminishing return over time, right? The longer the property, the older the property is, the less depreciation you're going to get out of it because it diminishes over time. That's number one, okay? Number two is back in 2017, the government changed depreciation laws, okay? So prior to 2017, regardless if you bought a brand new property or a second-hand property, you could depreciate the full property. When it comes to depreciation, there's two parts of a property that you can depreciate. First of all is the structure itself, okay? So basically that's pretty much the structure of the building, the frame, the roof and stuff like that. The second part of depreciation is called the fixtures, right? Which is basically the finishings inside your property. Things that can be pretty much renovated. For example, like your kitchens, the floorboards and stuff like that. And so these are completely different parts with its different line items of depreciation. When you buy a second-hand property after 2017, you're not allowed to depreciate the fixtures anymore. You can only depreciate the structure of the building. And the worst part about this is that even if the property is, say, for example, 1 day old. As an example, if I bought a brand new property today and then I sold it tomorrow to somebody, it's literally 1 day old, because it's a second-hand sale, I've sold it to, it's a private sale to another person, that person that bought this property that's only 1 day old will lose the fixtures portion of the depreciation for the entire life of the property. Not many people know this when they go out and buy a nearly new property as an investment, and they only realize after the fact that they've lost out on all of this depreciation just because they bought a 1 week old property or a 1 year old property, right? And so that's something you've got to be extremely careful of when it comes to brand new and secondhand property. And that's the reason why a lot of people, when they watch that part of my workshop, they get really surprised because it's not something that the government advertise. It's not something that people know about. And if you don't ask, you don't know.